It's now midday, so we'll make a start. I'm Tim Wood, Chief Executive of McInroy & Wood, and I'd like to offer a very warm welcome to the inaugural MW Client webinar. I hope you and your families are all managing during this extraordinary time and that we're now moving towards some semblance of normality. If I could just make a couple of housekeeping items before we start. The content of this webinar is McInroy & Wood's opinion, which may of course change over time, and it should not be seen as a promotion or indeed advice. If you find this session useful, then we'll continue to hold them on an ongoing basis. It would therefore be helpful to receive feedback on the event if you have any views about changes you might wish to see us make in the future, and you can do so by emailing your investment manager after the event. Many of you have already submitted questions prior to the event, but I encourage you to feel free to do so during the webinar by clicking on the Q&A button at the bottom of your screen and submit a question there. We'll do our best to get to them if they aren't already covered elsewhere. If we don't have time to answer any questions during the live session, your investment manager will respond to you afterwards. I'd like to assure you that all questions are anonymous, and while you can see and interact with us, no participants can see or hear each other. We will be making a recording of this session available on our website later this week. McInroy & Wood continues to function as normal, and we're enormously grateful to all of you, not only for your ongoing support, but also for the many positive comments we have received from you in recent weeks and months. It's incumbent upon us never to become complacent about our situation, something I am continually impressing upon all staff. However, we remain in a strong financial position and our investment process and systems continue to work well with us working from home. All staff have been working from home now for over 3 months, and it's been rewarding to witness the way in which they have adapted to the current circumstances while managing their own domestic situations. It isn't always easy for them, but I hope you've noticed little change to our service. Guido Bicocchi, our Director of Investment, will take you through a short presentation covering our investment view of the world. Liz Wild, one of our investment managers, will then provide a couple of examples of companies held in some of our portfolios to bring a little colour to our investment decisions. After about 20 minutes, we'll then move to our question and answer session, which will be chaired by Isla de Haldevang, our Client Administration Manager, during which time we'll try and answer the most common questions posed by you. Will Lindsay, another of our investment managers, will be joining us on the panel to answer questions, and Will has a particular interest in emerging markets. We'll be aiming to finish the session promptly at 1 p.m. Guido, over to you.
Thanks, Tim, and good afternoon, everyone. Global stock markets have suffered crises throughout McInroy & Wood's 35-year history, including Black Monday in 1987, problems with Asian debt in 1997, the bursting of the technology bubble in 2000, and the financial crisis in 2008. During such times of market weakness, we have always maintained our long-term approach, remaining focused on the preservation of capital and income after inflation. And our investment approach has not changed over the last few months. Portfolios were protected from the worst of the market falls through their conservative investment position, including allocations to bonds and gold where appropriate. As the effects of the coronavirus spread across the globe, we increased the frequency of our regular investment meetings, making use of video conferencing to discuss the changing merits of different assets, geographies, and companies. We quickly decided that while the pandemic would severely impact economies in the short term, the long-term prospects for companies remained attractive, particularly when compared to the returns offered by government bonds. In March, we therefore raised equity allocations in relevant portfolios from 60 to 65%. This is indicated by the dotted black line on the chart. This, alongside the discipline of frequent portfolio reviews, including taking profits on bonds and gold as their prices rose, and reinvesting those profits into company shares, meant that portfolios were able to benefit from the subsequent rally in share prices. As a result, the values of portfolios have recovered much of the ground lost in February and March, and as can be seen from the blue line on the chart, are above where they were a year ago. But thinking about the big picture is only part of our investment process. The team spend a large portion of their time reviewing individual businesses, either those already held in portfolios or possible additions, and Liz is going to talk about a couple of companies and the reasons why we've invested in them.
Thanks, Guido. So as you can see from this slide, we invest directly around the world in a range of different sectors and different regions. And this provides some of the diversification within clients' portfolios. So for example, we have Edwards, healthcare business that provides medical devices which are used to treat heart conditions. Closer to home, there's a business called Spirax Sarco, which is a global business, and they provide specialist steam systems which are used in manufacturing production. And the advantage of these systems is that they help their customers reduce their energy and water costs, and at the same time improve efficiency. So hopefully that will give you a little bit of a flavor of some of the names and where they're located. But as Guido said, a lot of the team's time is spent researching and analyzing these businesses. And what we're doing is looking for a particular set of characteristics. So it's not just about the products and the services, it's about where they're operating, what their margins are like, and also how well financed they are. So robust finances is something that we've spent a particular amount of time on recently to ensure that businesses can continue to operate through this difficult period. The quality of management is another element that we place particular emphasis on. And by investing directly, we can have direct contact with those management teams and gain a greater understanding of the business, their customers, and so on. But it also provides another element that feeds into our overall investment process because it gives us real insight into what's happening on the ground in different regions. And as the pandemic started to unfold, the first signs we saw was news coming out of businesses that had operations in China. So for example, there's one business called XP Par that actually had a factory in Wuhan. And so very early on, we understood that they were having to shut down and that there were challenges emerging. In the case of XP Par, fortunately, they had already started to manufacture elsewhere. So they had another facility in Vietnam that they were able to switch some of their production to. But you know, these situations are really quite fluid, and we're monitoring each and every company very closely. But this insight and this close contact enables us to make long-term decisions. And I'm sure you've heard us talk about that on a number of occasions. In an ideal world, we'd find great companies and we would buy and hold them forever. In reality, we sometimes hold businesses for 7, 8, maybe even 9 years, where the investment case still holds and it's still producing a good return for clients and their portfolios. And I'm going to talk about one of those long-term holdings, a business called Ecolab. So Ecolab is a US listed business, but it operates around the world. And it's a leader in what we describe as hygiene or infection control. So it may seem like quite a dull business, but in reality, what they're offering is really quite sophisticated. They've become the sort of trusted partner to lots of different sectors because their products and services do two things. They ensure the hygiene and sanitation levels in facilities or water purification are absolutely spot on. And at the same time, they're able to save their customers money by doing it more efficiently, using less water, less products, and even less labor. So this is something that's hugely valued by their customers. And as the business has grown and evolved, they've also started to do even more sophisticated things by gathering data to see how they can continually improve that service. So it's a business that's produced a very good return for our clients. And as you can see from the share price chart, we've been buying this company for clients since 2003. So some of you may have it in your portfolio. And it's been a steady upward movement. And part of what's behind that is that it's an essential service. So there's very regular revenue or sales, and that comes through in the profits that the company makes because they need to repeat doing their job. And there've been a number of trends that have been accelerating over the years. And the current crisis, we believe, will add further momentum to that as healthcare facilities or food and beverage companies need to tighten or add more frequent cleaning in order to ensure their places of work are safe. But what's slightly surprising, if you look at the far right-hand side of the chart, is that the share price fell quite sharply in February and March, along with many other companies. But as you see, it has recovered. What's surprising about that is it's quite a defensive business and one that we would normally expect to be less affected. But overall, we still remain very confident in the outlook for Ecolab. And whilst you can see in this bubble chart at the top, this is showing some of the different sectors that their customers sit in. The restaurants, the hospitality end of the world has been really hard hit by the crisis. And how and when they'll open up is still remaining quite tentative. So Ecolab has had a downturn in sales for these customers, but overall we think it will continue to grow over time. So hopefully in the question and answer session, we'll be able to give you some more examples of companies that we have within the clients' portfolios.
Taking a look at what's going ahead in the future, when dramatic events such as the coronavirus pandemic occur, people naturally focus on the immediate future. The global economy is in recession, employment is falling, as are company profits and dividends. But stock markets have already largely discounted these facts and are looking ahead at prospects for recovery. While we remain flexible in our investment strategy, we want to look through current events to consider the long-term consequences for investors. For example, the crisis has accelerated trends that were already in place in industries such as communications, healthcare, and technology. As described previously, we've taken the opportunity to consolidate the businesses in our portfolios that stand to benefit from such trends. Governments around the world have acted on a massive scale to prop up their economies. The austerity of the last 12 years has gone, and public sector borrowing is growing as a result. Central banks have also reverted to policies of quantitative easing, creating money out of thin air to stimulate activity. One important difference compared to the financial crisis in 2008 is that much of this support is being given directly to businesses and individuals, and is therefore more likely to find its way into the wider economy. There is a clear danger of rising inflation as a result, which could erode the value of savings. Our investments in inflation-linked bonds, as well as innovative companies with strong balance sheets, should help to protect portfolios in such a scenario. Of course, we mustn't forget Brexit or the upcoming US presidential election, the outcome of which have implications for international trading relationships. In conclusion, while we retain a long-term investment approach, the investment team's experience of stock market crashes and recoveries has taught us that we must constantly challenge the structure of our portfolios to ensure that they're able to face the challenges ahead and take advantage of the opportunities that lie ahead. And I'm going to hand over to Isla for the question and answer session.
Thank you, Guido. Just as Tim mentioned, we'll be covering questions raised in advance and those submitted during this live session. So Guido, can you get us started by answering a question concerning the impact of the current crisis on income? We've been asked, what is likely to happen to income from portfolios over the next 12 months?
Certainly, that's a question that we've been asked a lot in recent weeks. I think it's safe to say that the current environment is a testing one in which to try and sustain levels of income from portfolios. The lockdown measures have reduced demand for companies' goods and services, and many, quite rightly, as a result, are trying to conserve their cash until there's more certainty about the future. As part of those measures, many of them are cancelling or deferring dividends. I would say that much will depend upon the longevity of the crisis, but I think it's reasonable to assume that income from portfolios in the forthcoming year is likely to be significantly lower. Having said that, companies pay dividends throughout the year, and so we're hoping that by the end of summer we'll have more clarity about the position and be able to speak to clients about what they can expect from their portfolios. Tim, I'm not sure if you've got anything you'd want to add?
Yes, I think there is, in the majority of portfolios that are focusing on income, the bond element in the portfolios, while it's not providing much, it is providing some income, and that is absolutely certain until such time as the US and the UK governments stop paying interest on their bonds, at which time I think there'll be other things to worry about. So we don't think that's a likely possibility at all. And then it's really just how much confidence company management have looking forward in their own businesses to say, actually, we've got plenty of cash to pay out the dividends. and we don't need to carry on hoarding over 6 months. And in the majority of cases, companies are well able to pay the dividends that they have been paying. They're just being very conservative because of the uncertainty of looking forward. And hopefully we're now beginning to come out of lockdown. The bigger question people looking forward is going to be, is there going to be a second wave, as there was, say, for the Spanish flu, which was more dangerous. We're hoping that's not the case because of the various measures the governments around the world have taken to try and make sure there is no second wave, and therefore businesses should be able to continue and hopefully pay their dividends. But in the meantime, we absolutely are planning for fairly material cuts in company dividends at present.
Thank you, Tim. Well, this is a question for you. McInroy Wood invests all over the world. How do you manage to follow such a vast array of companies in such disparate locations? With a follow-up question of how often do you speak to those companies?
Thank you, Isla, and good afternoon, everyone. We have what we call our preferred list of companies. This is a list of stocks or companies that we invest in worldwide, and currently numbers around about 150 stocks globally. We try to meet or speak with these companies at least annually, and that can be in person in the UK or overseas, over the phone, or increasingly in video conferences. We've certainly found lately that company management are making themselves more accessible. So we're getting increasing time with the top people in our investments. Indeed, I've met online with companies from Brazil, India, China, Hong Kong in the last 10 days itself.
Super. Thank you for that, Will. Liz, have you anything to add in terms of the smaller companies management?
Sorry, Isla, the management of them or the contact that we've been having with the companies?
Yes,
The contact.
In the UK.
Yeah, so we invest in smaller companies around the world, and that contact is continuing. And as Will said, we're probably having more frequent conversations because news flow is coming out, how companies are adapting and changing their practices and opening up, and we want to stay close to management teams to understand that. And I think, just echoing what Will said, some of the management teams I think have got a little bit more time because they're not traveling around the world, but reality, we'd like those management teams to be managing the businesses and keeping investors up to date, but their day-to-day job should be ensuring that operations are moving, going smoothly in quite an unpredictable time, really.
Well, Liz, I think we'll stay with you for the next question. What is McInroy Wood's process for generating and evaluating new investment ideas? Okay,
so ideas come from all sorts of different places, really. We've got access to massive amounts of information and data through systems like Bloomberg and networks of brokers and so on. But quite often the ideas come from being on a motorway and seeing a lorry and then seeing another lorry which is the same name on it, or reading an article in a scientific journal that's talking about a new technology. And so it tends to sort of start the cogs in our brains working as to whether that's something that we can invest in, or whether there's an opportunity or perhaps even a threat to a business that we're currently invested in. So across the team, there's a wide range of experience in terms of some people having an accountancy background, or myself, I'm a biologist by trade, as it were. And so we bring all those things together, and formally we have a monthly new ideas meeting, but the team's really encouraged to just bring whatever idea it may be that has struck their imagination to the table. And then we'll discuss it and quite often sort of split off into groups, take it to the next stage, look at the wider sector, because quite often new ideas aren't always investable, or it's a case of they're not yet investable. So then we'll start to watch what's happening in that particular sector. So there's a formal process, and then there's this sort of informal process that everyone brings themselves.
Liz, if I might just add a little on our emerging markets approach. Clearly we follow the same process. We look at a different universe, and that universe in emerging markets is a very large one. But once we've really set our criteria, quality criteria, the types of companies we like to invest in, the universe becomes much smaller. We have a style, we have a preference to invest in the type of companies that benefit from the consumption of the domestic market within the emerging markets in these faster growing countries.
And Will, I think this is a related question, but we've been asked, what, if any, opportunities do you see in emerging markets in both the short and the medium term?
Okay, I think the short term, clearly there are emerging markets that have navigated through the COVID crisis better than others. Clearly, in East Asia, in China, in Taiwan and Korea, the responses have been far more effective. In Latin America in particular, they've been hit very hard. And there's really a question about how those economies, and particularly the politicians and the credibility of the politicians in those economies, might fare from here. So short term, I think challenges in those types of markets. Longer term, clearly demographic trends are growing, particularly in Africa, particularly in India as well. And it's the trends that we're seeing greater numbers of consumers have greater number of dollars in their pocket and therefore able to spend. And it's those types of trends that we want to invest in for the long term.
Thank you. Tim, I'm going to direct this question to you if I can. What accounts for the relative strength of equity markets since March? And the big question, which has been asked, is what happens next?
Isla, you broke up slightly on my end. Could you just repeat the question, please? Because I'm not sure if everyone heard that.
Of course. What accounts for the relative strength of equity markets since March, and what happens next?
Right. Well, this is certainly the second part is the crystal ball. But in terms of what has happened so far, is that the overwhelming response by governments and central banks around the world to support the financial system, and whether it's the Federal Reserve in America or the Bank of England here in the UK or the ECB in Europe, they have provided an enormous amount of money and liquidity to the financial system, and that has certainly helped prop up asset prices and kept interest rates at very, very low levels, as indeed they have been for the last 10 years or so post the financial crisis. So that backstop, if you'd call it that, that's created by the bank, where investors know that if anything goes catastrophically wrong, the central banks are going to step in and act as the lender of last resort, provides a great deal of confidence to asset markets. And that is why we've seen such a positive response in terms of equity prices regaining momentum from the lows that we saw back in March. So there are also other technical factors, not least those connected to an increasing what's called passive investment, where people buy index funds, and they are forced buyers and forced sellers when market goes up, markets go up and down. So they introduce elements of volatility into equity prices as well, that perhaps we might not have seen 20 years ago or so. Looking forward from here, it's quite clear and perhaps surprising that equity markets have regained the levels that they have. And to make further progress from here, what we're going to have to see, particularly from the companies that we're investing in, is a regaining of momentum in their sales figures and therefore their profits as well. And we would see their earnings beginning to grow again. And at the moment, the wider market is very much pricing in what they're terming a V-shaped recovery in the economy globally. And that means a very sharp bounce back from the huge falls that we saw in domestic and international output. And it's certainly our view that that recovery may well not necessarily be V-shaped. It may actually take much longer for companies to regain that momentum again, not least because there are big concerns over unemployment, not just here, but in America and Europe as well. Therefore people's discretionary expenditure falls because their income is either not low or isn't coming in at all. So there is a degree of caution there, but at the same time, there is a lack of alternatives. I mean, do you really want to be buying a German government bond and in return you've got to pay the German government 0.4% for the privilege of doing so? So that in itself has been creating a lot of momentum behind equity markets as well, is you've got to put your money somewhere, and actually putting it into real assets, which is equities give you a claim on real assets. That in itself is a very good place to be for long-term investors, and that is why we still continue to have confidence in equity markets going forward, is that in the long term, we think companies will continue to do well.
Tim,
I'd probably just add, Tim, that the key is probably that there's a clear end to the pandemic, and that's either through a vaccine or through herd immunity. And as we said earlier, I think stock markets look through the short-term noise and are anticipating that. However, the point that you've made about stock markets perhaps we're slightly less optimistic about the short-term future than current stock markets in terms of a V-shaped recovery. We've already seen second waves starting to rise in places like Germany and in Beijing. So it does depend on that and the impact that then has with their further lockdown measures on the prospects for companies. But as you say, over the medium to long term, we do believe that equities provide the best opportunity to provide growth in our clients' portfolios.
thank you, Guido and Tim. And I'm sorry, Tim, your sound quality does not. It wasn't so good at the end of that. So I hope everyone caught it. Now, Liz, I think you might be the best person to answer this next question, which is, why isn't there more exposure in the portfolios to tech giants like Amazon and Google?
Okay, thanks, Isla. Tech giants, well, we could probably debate this subject all afternoon. Lots of these names are very familiar to you all: Amazon, Google, Facebook, Netflix, or even Zoom that we're using for this webinar right now. So when we think about big themes like technology, which obviously over the last 10, 20 years have become really important, we like to sort of break down things and look at perhaps a slightly different angle to how we might invest in these areas. So whether it's a big company or it's a small company, we're constantly thinking about how it might fit into a client's portfolio, and also ensuring, as we've talked about, that it meets our criteria in terms of having the right characteristics and providing a good return for clients. Some of these really big new technology companies are perhaps not as profitable as people might think. And what we tend to focus on is, for want of a better word, the enablers. So businesses that will benefit from trends. So whether that's technology or healthcare or greater automation in manufacturing. So which are the kind of nuts and bolts that actually allow those businesses to do the things that we as consumers see on the other side. And I think we may have a slide that will give you some insight into the technology companies that are held within some clients' portfolios. Yeah, I think it should be coming up now. So we've got two categories here really. So we've got software and hardware, which is quite sort of traditional, and you'll probably feel quite comfortable knowing what those are. So SAP is a name some of you will know, but perhaps other names like ANSYS are less familiar. So this is software that's used by engineers when they're modeling new products, new systems, to kind of future-proof and test these things before they actually go live. So it's a very powerful tool. And then on the left-hand side, we have these enablers that I was talking about. So businesses that are essential to how these large technology companies work. And another new name that we added recently is a Dutch business called ASML. And in essence, what they do is they manufacture the machines that make microchips. Microchips go into all sorts of different things, from consumer products to big industrial items. And as technology is evolving, the demands on those microchips chips are growing, so they need to be more powerful, do more things so that we can have 5G, or a computer can process what it needs for artificial intelligence analysis. And ASML really are at the cutting edge of this. And through unique technology that they have, they are able to make these really powerful microchips. So when we looked at the business with fresh eyes in March, we felt that the future was good for it, and also that the valuation, so how expensive it was much more attractive than one of these big sort of glamorous technology companies. So that's how we're approaching it.
I'll follow on, Liz. In terms of our particular Asian exposure, we hold a company, it's on the slide there, called Chroma, that we've actually held for now probably some 13 years. And it really extends the theme of technology enablers. They are leaders in power supplies, testing of power supplies, particularly in the semiconductor sector, increasingly the solar sector, and particularly the electric vehicle sector. Indeed, Tesla are one of their very biggest customers.
It's also worth saying we've all started to use more technology in the last 3 months because of the lockdown measures. So many of us hadn't used Zoom before the last 3 months. We're ordering more things from the likes of Amazon, and the stock markets, if you look at the share prices of those particular companies, have done very well over that period. However, as we've been saying throughout the presentation, our job is to focus on the long term, and it may be that some of these trends have been accelerated, but we're more conscious of looking at some of the enablers and some of the companies that sit behind these well-known names and perhaps have a greater exposure to the theme rather than individual companies themselves.
Thank you all. Will, I think this question is to you. Why do you hold gold in the portfolio, and how is it held? A client's asked.
Thanks, Isla. Well, we first added gold to our portfolios back in 2016, and it was then, and still is now, really seen as a diversifier for portfolios. It was also seen as some form of insurance in the event of far more significant market setbacks, or indeed a loss of confidence perhaps in central bank policy or paper money. The gold is held in what are called exchange-traded funds. Each of those funds have physically backed gold for every share we buy in those funds. Indeed, one of our colleagues inspected the said gold a couple of years ago in London.
I think I'd just add that gold is part of the insurance within our portfolios. It's not held in all portfolios, but where it is, it's part of the insurance alongside the bond holdings. And we saw earlier this year that when the share prices were falling, the portfolios benefited and were protected from the worst of those falls by the fact that their holdings in bonds and gold went up in price. So that's very much the role that they play within our portfolios.
Thank you.
If I could just jump in there, Isla, just to finish off that, gold also has the double benefit of not only being an asset that people fly to when they're very concerned about what's going on in the world, it's also an asset that's priced in dollars as well. And very often when there are concerns in the world, people will move to dollars, being seen as the reserve currency of the world today, as it has been for many, many years. And as a result, the dollar tends to get strong against sterling. So not only do we benefit from a rising price in gold, we also benefit from a strong dollar as well.
Thank you. Guido, can I ask this question of you? Would you expect any problems selling investments if markets collapse again? And what about amongst smaller companies? So I suppose that's the client's divided it into two sections.
The short answer is no. It's liquidity, which is our ability to sell the investments within portfolios in order to return the cash to investors. Has always been something that we've monitored in portfolios. We're recognise the fact that we manage money on behalf of individuals, families, and trusts, and there's a good likelihood that they will want some of that money back at some point, whether it's to pass on to the next generation, or buy a new house, or do some repairs. So we've got to have liquid investments within the portfolios in order to allow us to do that. We monitor the liquidity of the investments on a regular basis. But one thing that we have done over the last few months is to increase that monitoring, so that in the times when markets were moving significantly, we wanted to make sure that that liquidity was being maintained. And ironically, we actually found that the liquidity increased because there was so much trading going on. But it's certainly something that we would continue to monitor, as I say, and something that we will make sure that we're on top of going forward.
Going into the COVID crisis, when we went into lockdown and there was really global panic at that point in time, the only fear that we had about liquidity was that global stock markets would be shut. In other words, people just were not allowed to trade. That possibility, in terms of the risk it poses, is diminished materially. Not least because the technology has been proven for everyone to be able to work from home. But it still remains, and obviously if stock markets were not open, then we couldn't sell the investments within portfolios. But that is a very, very unlikely possibility in our view.
Thank you. And Guido, a question's come in. What does coronavirus mean for international trade?
Well, it's probably worthwhile going back and creating some background here. We've had a period since probably the 80s where there's been growing international trade as companies have sought to move their production facilities around the world to where it's cheapest for them to make things. We'll all be familiar with the Made in China tag on the back of clothing, etc. But in recent years, we've seen a rise in populist politicians. So, for example, Donald Trump in America. And alongside that, we've seen a growing trend of protectionist measures, so tariffs and trade disputes. And that started to interrupt this growing trend of internationalization. We mustn't forget, obviously, Brexit as well. That's another example where populist measures have got in the way or are getting in the way of trade. So before the pandemic hit, we were already starting to see some of this international trade starting to break down. And the pandemic has accelerated that in some ways because it's disrupted supply chains. So, for example, if you take passenger aircraft, a large number of high value goods were actually transported in the holds of passenger aircraft. So as the number of flights have fallen and disappeared in some instances, the ability for companies to transport goods around the world quickly has also disappeared, and therefore their costs have gone up as a result. So companies, how have they reacted to that? They've started to move production either closer to home or actually back to their home countries in order to try and protect themselves against some of these disruptions and potential disruptions to their business. And ultimately that may mean that the cost of making things goes up. So we might have inflation because it may be that the cost of a worker in the UK is going to be higher than the cost of a worker in Vietnam. And that then means that from our point of view, when we're looking at companies, we're very much focused on trying to invest in companies that are innovative and have strong market positions, such as XP Power that Liz mentioned earlier, where they're therefore able to better protect the price that they then charge to their customers and can pass on this inflation in their costs. I think the other thing to say is that it's not just one-way traffic. So if we look at what we're doing just now, we've got video conferencing in the services industry. We've certainly found that people don't have to work in expensive cities like London or San Francisco. They can quite easily work in places like the Highlands. And as long as they've got good internet connections, they can operate efficiently over things like Zoom. So it may be that we see an opposite trend in services businesses. So people may start to employ technology engineers in emerging markets. Will, I'm not sure if you've got something you might want to add to that.
I think, Guido, the emerging markets clearly are at a stage of development when they're the investments into emerging markets are ones we're really making on a long-term basis, and the trade is becoming, I think, more regionalized perhaps in emerging markets. We're seeing a lot more so-called South-South trade from China until its other trading partners. But the challenges we've seen clearly from Trump's recent policies has perhaps pushed different emerging markets to look to source things from different places, particularly in Asia, perhaps Vietnam and other lower cost centers.
Thank you.
If I could just hop in on the end of that. There was, in fact, a very interesting article in this morning's Financial Times by Martin Wolf. Yes, there is an element of protectionism creeping in that's not just been triggered as a result of COVID, but it was going to come, not least because Trump's America First policy, and that's been reflected around the world too. But it's quite clear that countries gain economies of scale, as Martin Wolf was saying, by trading with each other. And the idea that international trade is suddenly going to cease, again, I don't think is something that will happen, because it's in no one's interest. It can happen for short-term political reasons, but politicians change and policy changes with them. And indeed, there may be such a change in America later on this year. We'll just have to wait and see.
Thank you. Liz, this question, I think, to you. Has the emphasis on climate change slipped as a result of the pandemic?
Okay. Well, the climate change agenda has certainly risen in terms of priority over the last 12, 24 months, and rightly so. Because we are kind of facing quite a serious situation. We're all aware, whether it's locally or around the world, how extreme weather conditions are affecting different regions, whether that's flooding or forest fires. And I think rightly so, governments as well as companies have started to take on board what individuals in the street have been concerned about. However, in the short term, we are in the middle of a healthcare crisis, and rightly, I think that is the priority. But what's interesting is, whilst it's disappointing that the COP26 round of environmental meetings that were due to happen in Glasgow this year has been postponed, what we've also seen, particularly from the European governments, is a desire to look at how they can fold things into their economic recovery plans. So as they start to open up and unlock, if you will, they're seeing how can they adjust and how can they support different industries and sectors so that recovery incorporates these things and considers it better. And on the company level, I would say, over the last 20 years, companies have certainly had to take these issues far more seriously, whether that's how they disclose things or their willingness to engage with shareholders. And that's something that we certainly feel is very important as part of our role, not only to protect value for our clients, but also in that kind of stewardship role, because we have the ability to push things that, overall we feel are important and companies should be doing more about.
Thank you. There is a follow-up question to this, which is, what is the team's view on Shell and Total? I can see how it rolls into that.
Shall I start with that one? And then maybe, yeah, I'll start with that one. So some of our clients will have Shell or Total in their portfolios. And that's something that's constantly under review. We have a monthly meeting where we look at every single investment that's held in clients' portfolios. And we basically review the news, discuss them and consider whether they're still playing the important role that we expect them to in that client's portfolio. When it comes to Shell and Total, I think there's a sort of a pivot going on. Within that particular sector, there are some companies that are unwilling to acknowledge climate change, are unwilling to reorientate their portfolio of assets, perhaps away from some things like coal or tar sands oil, which are regarded as hugely polluting. And then there are others like Shell and Total that I would recategorize as energy businesses. So they have accepted climate change, and they are also looking at how they can transition and be part of that transition, because unfortunately we can't simply turn off oil and gas. We have perhaps passed peak oil, that's the information that we're getting from leaders in the sector, but the likelihood is demand for gas will continue for some time yet. And that switchover, that gradual move into renewables will take time. And Shell and Total and other leaders in the energy markets are well positioned to take capital and move it into these areas. So at present, we still think there's a role for those companies in some of our clients' portfolios. But as I said, it's constantly under review.
Yes, it's a very emotive subject, oil particularly. And I know it's certainly been vexing charity trustees, and many have taken a view that they don't want oil in their portfolios. And there is no doubt that clearly oil companies are part of the problem. But we also believe that oil companies are actually part of the solution as well, primarily because the amount of money that they're actually investing in renewable technologies, recognizing the threat to their traditional business, but also really making headway on their renewable investments. So Shell, for instance, is investing around £2 billion of its capital expenditure budget on renewable energy today. And our role primarily as shareholders, and our responsibility as shareholders, is to not just try and get the likes of a Royal Dutch Shell or Total to set targets by which they may be carbon neutral, but to try and be more ambitious and to bring some of those targets forward, and to say, look, setting 2050 as a target to be carbon neutral is not acceptable. You've got to be more ambitious than that. You've got to invest in renewable energy to an even greater extent than you are at the moment. And of course, as a shareholder, there are risks and rewards to that transition as well. But as it stands, we don't think oil is going to go away tomorrow, not least because we all actually need it in our everyday lives, and that transition will take time.
Thank you. The next question, I think to Guido, what is your approach to investing in the UK after Brexit?
Well, I think the Brexit has obviously created a large amount of uncertainty, particularly in the short term. And that's made the UK a much less attractive place to invest, either from our point of view or from businesses themselves. We've seen that being felt most readily in currency. So the pound has gone down in value against virtually everything else around the world. And what we've done and did ahead of the Brexit vote in 2016 was to move the portfolios to have a greater emphasis in overseas investments, so that without doing anything else, the portfolios benefited from that weakening of the currency. And I think we see that continuing until we do get some greater certainty about the future trading relationship that Britain will have with Europe and other countries around the world. So that's how it's impacted what we've done in the short term. In the longer term, British businesses will want to trade and will continue to with their European and counterparts and other businesses around the world. So they will find a way through the red tape that comes from the Brexit negotiations. And from that point of view, we very much want to continue to focus on high quality businesses wherever they're listed, whether that's in the UK, for example, Spirax Sarco that Liz was talking about earlier, or whether it's in Europe or America or the emerging markets. It's very much we look for the best businesses to put into the portfolio, no matter where they are.
Thank you. So in terms of, I think, again, this is to you, Guido. A question's come in: what impact does perceived quality or stability of political leadership have when you're constructing portfolios?
I think it's important to say that politicians are very short-term or relatively short-term in their views, because obviously they're being re-elected on a regular basis. So from one point of view, it is important because we need to be aware of what standing politicians or political parties' policies are, particularly in things like tax, investment in business, and ultimately what that then might mean for some of the companies that we're investing in. It also means that more so in some of the emerging markets where they don't have the same checks and balances as perhaps we have in Western worlds. For even with Donald Trump in America, they have checks and balances to stop them doing too many silly things. But in some of the emerging market countries, they just haven't did that yet. So it's probably a bigger consideration there. Over the long term, though, we very much look to invest in businesses, as Liz has said, for 9, 10, 11 years, ultimately, ideally forever. So when we're looking at those companies and the prospects for those companies, the political environment and the perceived quality of that environment then influences whether we think the short-term future of those companies is either going to be benefited or disrupted. So taking an example of the upcoming US election, there's a lot of discussion about healthcare there and the perceived cost of healthcare, because it's one of the most expensive places to be treated in the world. And our view is that that may well lead to some pressure on the cost of healthcare, and therefore some of the companies that we invest in, that, for example, Edwards Life Sciences that Liz was talking about earlier, that benefit from some of those revenues as people get heart surgery, etc., they may well come under pressure in terms of the cost of their own individual goods. So in the short term, we need to be aware of that and factor that into our investment decisions.
Just following on, Guido, from your comments about the emerging markets and politics, clearly emerging market stock markets are heavily driven by foreign flows. We tend to see significant euphoria if it's seen that a new incumbent leader might be business friendly or might be driving reforms that might help these economies go forward. What we've got to be aware of is where these reforms are perhaps concrete and maybe long lasting versus perhaps short-term political messages, and it's a very big driver of return in emerging market investing.
I aim this to Tim. The questions come in. Do the panel foresee a time when there will be a pressure from the general population for their governments to stop propping up asset prices by pumping money into the system whenever it looks like equity investors might lose some money?
Yes, so that is an excellent question, and the governments, whether it's here in the UK, Europe, the US, have taken themselves down a road of printing money that it's going to be very, very difficult for them to step away from. And the slightest sign that that is what they might do will be the point at which people lose faith in paper money. That's when real assets matter. It's when particularly assets like gold come into their own. It would be difficult to envisage any government trying to step away from its obligations in the Western world. They do it frequently in some of the emerging markets. Argentina, for instance, has had a history of doing so. But that is not typical of Western markets, and any attempt to do so by governments in the Western world would immediately undermine asset prices. So in printing money and borrowing, creating liquidity, it has created a situation that is going to be very difficult for them to row back from. In fact, they may well go further from here, and there are examples that have set precedent that the government may in fact start investing directly in equity markets. And there is some irony looking back to the UK election back in December when Jeremy Corbyn wanted to spend vast amounts of money on public and the health service, nationalise industries, and that seems to be where we are now going, so under a Conservative government. So I can't really envisage governments ceasing, other than through naturally where what they want to happen is economies starting to recover and taking over, and then they can gradually withdraw that level of support as markets become more self-sustaining. But again, I think that is some way away as yet.
Thank you. I can see that the clock is ticking, so this will be your penultimate question. Tim, I think I can address it to you once more. What is your view on China and its role in the global economy? You've been asked.
The ascent of China has been a major feature of global economies over the last 20, 30 years now, and it has come from a position that really has been relatively small. and has made that ascendancy quite quickly. If one were to go back several centuries, China was a preeminent power in the global economy then too. China's approach is very different to that of some of our Western countries. They're very long-term in nature, and with all their planning strategically, despite the fact that they're run as a communist country, is long-term in nature, and therefore they play the long game. So when it comes to trade negotiations, which we've been talking about, and interacting with the rest of the world, they are prepared to make short-term sacrifices if it means that they think in the long term they're going to win. They've been hoovering up assets around the world, whether that's miners. They've been very active in Africa as well. They're a presence that is here to stay, and in some ways it can easily be argued that America has been the sole superpower for too long, and having a yin to America's yang, and starting to create a bit more balance in the global economy, I think is no bad thing in itself. However, America is not going to give up its position easily, and will fight, and that is where some of President Trump's protectionist measures come in. But China is a force, and it's a force that's here to stay. At the moment, a lot of its financial plumbing is quite underdeveloped. And as that begins to develop further, it will become more and more investable. We are actually capable now, and there aren't so many firms that can do this, of investing directly in Chinese securities. And that's, again, planning that we put in place several years ago, and it's taken some time to actually come to fruition. But we are in a position to do that, should we now want to do it. But obviously one has to take care, because it is an undeveloped market, financial market.
Tim, just to follow on China, one last comment I would say is that the ultimate long-term trade-off that Communist Party is making is by enabling economic growth and rising living standards in return for limited personal freedoms and democratic freedoms. That's what they're trying to juggle on an ongoing basis, and that's really the main role of the party.
Thank you. I'm very aware of the time, and so Guido, if I can ask this of you, we have been asked what the investment team's view on the US election, and apologies, you're going to have to get it in under 1 minute.
Well, we've obviously, neither of the two candidates have officially been announced, but it looks like it's going to be Biden versus Trump. Donald Trump is basing his election on the economy, and he's desperate to get the economy going again, which is why we're seeing the lockdown measures being relaxed so quickly. So if that happens and he wins his bet effectively, and the economy does recover, then his support may well swell, and we may see him return to the White House. However, the danger is that, as we've already started to see, there may well be a second wave of the virus, which then results in further lockdown measures, in which case his economy is impacted. And that may then open the door for Biden. In terms of what it means for us and our investments, there are actually quite a lot of similarities in their positions, particularly as healthcare, as I mentioned earlier. Both parties seem to want to reduce the cost of healthcare. And although Donald Trump is touted, and there's much written about him in terms of his foreign policy and his trade disputes, etc., I think Joe Biden may well be along the similar lines in terms of he's not going to roll over. The trend that we've seen in terms of the relationship with China is one that would continue under either president. Hopefully that's quick enough and fulsome enough.
Thank you very much. Thank you to all of you for your very pertinent questions. Now, I'm now going to hand it back to Tim.
Thank you. I will just to sum up, just a few key messages to leave you with. We're still finding new opportunities in equities around the world, and there always are opportunities, even in times of stress. But we're continually assessing the risks posed to your portfolios and remain absolutely disciplined and calm in what we're doing. And we do have great confidence that our long-term investment approach will continue to work and to meet your needs as well. So if you do have any feedback about this webinar, please do email your investment manager. I know, because I've been seeing them come in, that you've asked a great number of questions, and we've only managed to get to some of them. and we will be coming back to you to answer those questions you've raised if we haven't done so in this meeting. In the meantime, thank you for participating in this session, and I hope I, or indeed one of my colleagues, can look forward to seeing you face to face in the not too distant future. Until then, wishing the very best to you and your families. Thank you.